So till now we discussed about the material cost variances and labor cost variances. Today we will discuss about the overhead cost variances. Just for a quick recap, overheads are those costs which we cannot directly assign to the final product. So it is the summation of indirect material, indirect labor and indirect expenses. So if we add indirect labor, indirect material and indirect expenses together, what we will get is the total overhead, right? And we can also segregate on the basis of functions. Like for example, we can consider the production overheads, the marketing and selling overheads, administrative overheads separately, right? So these things we have already discussed before when we discussed the overhead cost, right? The measurement of overhead costs. In this session, what we are trying to assess is that your actual overhead cost and the standard overhead cost, whether there is any deviation or not, if that deviation is favorable or unfavorable. If it is favorable, then how much? If it is unfavorable, then how much? If the deviation is too large, then we need to dig deeper into the causes of it, right? And try to find out that why it happened and how it is to be eliminated, right? So first, what we are doing, we are trying to measure the overhead variances. So these are the objectives: define overhead variances and their components, understand variable overhead cost variance, learn about fixed overhead variances and subvariances, analyze how favorable and adverse variances affect the business performance. Fine. So these are the objectives of this session. So introduction. Overhead variances are the differences between the standard overhead costs allocated for production and the actual overhead costs incurred, right? And what are the types? So it is just like material cost variance and labor cost variance. Here is also it is the difference, right? It is the difference between what? Between the standard overhead cost and the actual overhead cost, right? So what are the types? There are two types. One is variable overhead variances, second is fixed overhead variances. So variable overhead variances and fixed overhead variances, these are the two types. So favorable and adverse. So just like before, you are already aware that it is favorable, the variance is favorable when the actual costs are lower than the standard costs. This indicates better than expected performance if workers complete a task in less time or at a lower rate than expected. It leads to a favorable variances. Impact results in cost savings or higher efficiency. Fine. Similarly, the adverse variance occurs when the actual overheads are higher than the standard overheads. This suggests what? This suggests inefficiency and excess cost, right? So, for example, if the actual fixed overheads are rupees 20,400, but the budgeted cost is rupees 20,000, the variance is adverse. Fine. Okay. So first one is variable overhead cost variance, very similar to the material cost variance and labor cost variance. So what is the formula? Formula is standard variable overhead for actual output minus actual variable overhead, right? So this is the difference between the standard variable overheads for actual production and the actual variable overheads incurred, right? So you take your actual output, calculate as per standard what should be the variable overhead, and then you compare it with the actual variable overhead incurred. So the difference is the variable overhead cost variance. We can also total variable overhead cost variance, right? So if the actual variable overhead is more than the standard variable overhead for actual output, we will say that it is adverse. So we can do it like this. If actual variable overhead, right, it greater than standard variable overhead for actual output, we will say it is adverse, right? We will say it is adverse. And vice versa, if actual variable overhead is less than standard variable overhead for actual output, I will say it is favorable. Fine. Okay. Now, here is a problem, right? Standard output is 400 units, actual output 500 units, standard variable overhead 1800, actual variable overhead 2000. Calculate the variable overhead cost variance, right? So, the formula is what? Standard variable overhead for actual output minus actual variable overhead. So, this is the formula, right? So, standard variable overhead rate is how much? 1800 is the total variable overhead it is given for 400 units. So, it is rupees 4.50, right? So, your variable overhead variance will be actual output, standard variable overhead for actual output. Your actual output is 500, standard rate is 4.50 minus the actual overhead, it is given, it is 200. So, this 200 will come here, right? So, it is 500 into 4.50, it is 2250 minus 200. Now, you see the actual variable cost, in this case, the actual variable cost is lower than the standard variable overhead. So, it is favorable, right? How much? The difference between the two, that is 250. What is the interpretation? The favorable variance suggests that the company incurred lower variable overhead costs than expected. Fine, okay. Fixed overhead variances. So, this is for variable overhead. Fixed overhead variances, these variances arise when the fixed overheads differ from standard cost due to changes in the production levels, right? So, fixed overhead volume variance, two components, fixed overhead volume variance and fixed overhead expenditure variance. So, fixed overhead volume variance, the definition is the difference between the budgeted hours based on the normal volume and the standard hours for actual output. So, formula is FOBV is equal to standard fixed overhead rate into standard hours minus budgeted hours for actual output. So, we can use this formula for calculating the fixed overhead volume variance. So, here is one problem. Budgeted output is 10,000 units, actual output 10,400 units, budgeted fixed overhead rupees 20,000, actual fixed overhead rupees 20,400. Calculate the fixed overhead volume variance, right? So, FOVV is equal to standard fixed overhead for actual production minus budgeted fixed overhead, standard fixed overhead for actual production minus budgeted fixed overhead, standard fixed overhead rate is equal to budgeted fixed overhead divided by budgeted output. So, budgeted fixed overhead is 20,000, so it is 20,000, budgeted output is 10,000, so 20,000 by 10,000 is rupees 2 per unit, right? Standard fixed overhead for actual production is equal to standard fixed overhead rate into actual output units. So, standard fixed overhead rate is, we calculated here, it is 2 rupees 2 into 10,400 units, that is the actual production. Here it is given 10,400 is the actual production. Fine. So, if I multiply, I am getting 20,800, right. So, FOBP is rupee 1 into, right, rupee 1 into 20,800 minus 20,000. So, rupees 800 favorable. Fine. Okay. Interpretation: the favorable variance indicates that the company produced more units than budgeted and absorbing overheads more efficiently. Fine. Okay. Fixed overhead expenditure variance, it can be defined like this: the difference between the budgeted fixed overheads and actual fixed overheads incurred, right. Formula is budgeted fixed overhead minus actual fixed overheads. Here is a problem. Budgeted fixed overhead is 20,000, actual fixed overhead is 20,400. Calculate the fixed overhead expenditure variance, right. So, formula is budgeted fixed overhead minus actual fixed overheads. So, budgeted fixed overhead is given 20,000 and actual is 20,400. So, actual is more than budgeted, so it is adverse 400. Interpretation: the adverse variance indicates that the actual fixed overheads were higher than the budgeted and increasing costs. Here is a problem. Standard hours for actual output, right, 20,800 hours. Actual hours worked 20,100. Standard fixed overhead rupee 1 per hour. Calculate the fixed overhead efficiency variance. So, formula is fixed overhead efficiency variance is equal to standard rate into standard hours minus actual hours. Standard rate is given here rupee 1. So, rupee 1 into 20,800 standard hours minus 20,100 actual hours worked, right. So, it is actual hours worked is less, so it is 700. So, rupee 1 into 700, it is favorable, right, is favorable. Fine. This favorable variance indicates that the company used the fewer than expected and reflecting better efficiency, right. So, in summary, overhead variances are crucial for monitoring cost control in production. Variable overhead variances help manage the change with production levels. Fixed overhead variances show efficiency in utilizing production capacity and resources. Thank you.